Hello, and today I'm going to be doing Cashflow Quadrant by Robert Kiyosaki. 1. Diversification. People who seek security use the word diversification a lot. Why? Because the strategy of diversification is an investment strategy for not losing. It's not an investment strategy for winning. Successful or rich investors don't diversify. They focus their efforts. Warren Buffett, probably the world's greatest investor, says this about diversification. The strategy we've adopted precludes our following in standard diversification dogma. Many pundits who therefore say the strategy must be riskier than that employed by more conventional investors. We disagree. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort he must feel with its economic characteristics before buying into it. In other words, Warren Buffett is saying that portfolio concentration, or focusing on a new investment rather than diversifying is a better strategy. In his mind, concentration rather than diversification requires you to become smarter and more intense in your thoughts and actions. His article goes on to say that the average investors avoid volatility because they think volatility is risky. Warren Buffett says instead, in fact, the true investors welcome volatility. When Kim and I were escaping from financial struggle to financial freedom, we didn't diversify. We concentrated our investments. Blue chip stocks. Security-minded investors usually buy the blue chip companies. Why? Because in their mind, they're safer. While the company might be safer, the stock market is not. These stocks won't protect your money in a market free fall. Mutual funds. People who know little about investing feel more secure turning their money over to a fund manager who they hope will do a better job than they can. This is a smart strategy for people who have no intention of becoming professional investors. But the problem is that, as smart as this strategy is, it doesn't mean that mutual funds are less risky. Today, the market is filled with millions of people who, by nature, are security-minded. But due to the changing economy, they are being forced to cross from the left side of the Cashflow Quadrant into the right side, where their brand of security doesn't really exist. That causes me concern. Great economic upheaval is coming. The stage is set for a great economic upheaval. Such upheavals have always marked the end of an old era and the birth of a new one. At the end of every age, there are people who move forward and other people who cling to ideas of the past. I'm afraid that people who still believe their financial security is the responsibility of a big company or big government will be disappointed in the coming years. Those are ideas of the industrial age, not the information age. No one has a crystal ball. I subscribe to many investment news services, and each one says something different. Some say the near future is bright. Some say a market crash and major depression are right around the corner. To remain objective, I listen to both sides, because both have points worth listening to. I do not play fortune teller, trying to predict the future. Instead, I work at staying educated in both the B and I quadrants and being prepared for whatever happens. A person who is prepared will prosper no matter which direction the economy goes, whenever it goes. If history is an indicator, a person who lives to the age of 75 should anticipate going through one depression and 2 major recessions during his or her lifetime. My parents went through their depression, but the baby boomers have not yet. Today, we all need to be concerned with more than just job security. I think we must also focus on our long-term financial security and not leave that responsibility to a company or the government. The times officially changed when companies said they were no longer responsible for your retirement years. Once they switched to the defined contribution retirement plan, the message was that you were now responsible for investing in your own retirement. Today, we all need to become wiser investors, always aware of the ups and downs of the financial markets. I recommend learning to be an investor rather than giving your money to somebody else to invest for you. If you simply turn your money over to a mutual fund or an advisor, you may have to wait until you're 65 to find out if that person did a good job. If they did a lousy job, you may have to work for the rest of your life. Millions of people will have to do that just because it will be too late for them to invest or learn about investing. Okay, I hope you liked that. If you did, please like and subscribe. Bye!